Welcome to the deep dive. Today we're really focusing in on Aircastle Limited, their Q2 FY 2025 update. This one dropped pre-market, and honestly, with those big credit rating moves recently, maybe the strategy talk is, even more important than the raw numbers.
Oh, absolutely.
Yeah.
If you follow aviation leasing, this call was all about execution. It's a story of, let's say, disciplined growth, getting that big stamp of approval from the ratings agencies, and they did it right when the aviation market is probably the tightest it's been in years, really capitalizing on that.
Right. So let's hit the snapshot first. Top line revenue came in pretty strong, $227.5 million. That's up about 5.0% year over year. Solid, maybe what you'd expect.
Solid, yeah, but the bottom line, that really took off. Net income hit $57.2 million. And just to be clear, that's nearly a 100% jump compared to last year.
Right.
Huge. Adjusted EBITDA backed that up too, landing at $262 million. Shows, really strong cash generation happening underneath.
And operationally, it seems to check out. Fleet utilization, almost perfect, 99.7%. They said 100% of their own planes were on lease at the end of the quarter, which sounds great, but hang on. In a market this tight where finding any plane is tough, isn't 100% utilization almost just like the baseline?
Yeah.
Where's the real skill there?
Well, yeah, placing the plane is one thing, but the execution shines in the kind of deals they're cutting, the quality, the length of the lease terms they're locking in, and crucially, taking financial risk off the table. That high utilization, it gives them the power, the leverage to really push lease rates up when renewals come. They're not just filling seats, they're boosting the yield.
Okay, that makes sense. And that leads us right into the profitability drivers, because that massive jump in net income wasn't just, things ticking along nicely. It was driven by a couple of really specific things. First, core leasing did great, up 17% year over year to $190.1 million. Plus, they had good gains on selling older planes, about $23.9 million there.
But here's the really interesting bit, the structural cleanup item. They booked $56 million in other income, and that was entirely from those Russia-related insurance settlements. And crucially, they confirmed it's all collected now, cash in the bank.
Right. So that overhang, that risk that the market was maybe worried about, it's gone.
Exactly. That piece of tail risk is now off the books. It just cleans up the balance sheet immediately. Big news for them.
And beyond cleaning up the finances, they were also really busy shaping the fleet itself, asset quality focus. They bought 11 aircraft, spent about $503 million. But the key number there is the age, right? Average age is just 3 years old.
Very young.
Right.
And that's the deliberate strategy. They sold 4 older planes at the same time. Average age there was 18 years. Got $73 million for those. So this active management, this trading, it got them to their goal. New tech narrowbodies are now half the fleet's value, the net book value, which, means better emissions, better fuel burn for their airline customers, and probably holds value better long term, too.
And focusing on that new tech, that clean execution, well, it paid off with the credit agencies. That was a massive win this quarter, maybe the biggest structural shift. S&P bumped them up to BBB in August, then Moody's followed in October, bait too.
Yep. Dual investment grade, that's the threshold. Crossing over from high yield, it's a big deal.
So what does that actually do for them, practically speaking?
It fundamentally changes their borrowing costs. It's not just a nice label. Because they got those upgrades, they could immediately go out and issue $650 million in senior notes, unsecured.
Right.
And the rate was really competitive, 5.7%. This move basically shifted almost all their debt, like 98% of it, to unsecured status.
Okay, unsecured debt. For someone maybe not deep in aviation finance, why is that important? Reducing asset encumbrance risk, what does that unlock?
Maximum flexibility, basically. When debt is secured, specific planes are tied to specific loans. They're encumbered. By moving to unsecured debt, they free up all those assets. Makes it way easier to sell planes later if they want to, makes it faster and cheaper to finance new planes. And, if they ever looked at M&A, it simplifies things massively. Plus, they're sitting on $2.5 billion in total liquidity. They've really set up the structure for growth.
Right. Okay, let's zoom out a bit. Investor context. Is this kind of success sustainable? I mean, they're clearly riding this wave of market tightness, and the big picture seems to support it. IATA traffic numbers look good. August 2025 saw growth globally. And that load factor number, 86% industry-wide, that's historically high. Every plane is packed.
Yeah, and connecting that to Aircastle, the supply side issues are really the bedrock supporting these strong results and high lease rates. It's structural. We all know about the OEM delivery delays. Airbus is still behind schedule. Boeing's trying to ramp up the Mac X, but it's slow. Depends on the FAA approval step by step.
And the elephant in the room is still the engines.
It's exactly. The Pratt Whitney GTF engine inspections, these aren't minor checks. They're grounding planes for extended periods. It's taking a big chunk of the A320neo fleet offline, realistically through 2026, maybe even into 2027. If you're running an airline, that's a huge headache. Just a nightmare for scheduling and costs.
And you see the direct result in Aircastle's numbers. Demand for lease extensions was massive. 14 extensions they did in the first half of the fiscal year. Only 2 planes actually transitioned to new lessees.
Confirms airlines are just clinging on to whatever planes they have that can fly. And that keeps the value of those midlife aircraft, the slightly older ones, really firm.
Which brings us to consolidation. M&A, did management talk about that?
They did touch on it. They acknowledged, yeah, getting bigger has benefits. Better access to funding, more liquidity, maybe more clout when negotiating with Boeing and Airbus.
But they weren't jumping at deals.
No, seem pretty cautious. So they're sticking to their plan for now. Noted that trying to buy big portfolios right now is tough, very competitive bids. Sounds like they're focused on growing profitably, disciplined returns, not just chasing expensive assets because the market's hot.
Okay. And what about headwinds? Did the Spirit Airlines Chapter 11 filing hit them? That was pretty big news.
It did, yeah. And this shows you the complexity. Even in a strong market, Aircastle confirmed 5 of their planes were part of that fleet rejection by Spirit. And those rejections fed into the impairment costs they took this quarter. About $31.2 million in operating costs was related to that. Management thinks those 100-plus planes rejected across the industry will find homes, probably outside the U.S. eventually.
But there's a catch, right? Especially with the engine problems we just talked about.
Yeah. It's exactly the catch. Many of those rejected planes need serious maintenance, shop visits, before a new airline takes them. But the repair shops, the MRO slots, especially for GTF engines, are already jammed because of those fleet-wide inspections. So finding a slot to get the work done delays putting those planes back into service significantly. So it raises this interesting tension for investors, for you listening. You've got this placement risk for specific planes coming back versus the overall strong pricing power they still have because of the broader supply shortage. It's a balancing act.
Okay, let's pivot. Time for a segment. This is not financial advice. We take the story we just heard and spin out a, let's call it, outrageous but plausible trade idea for you to mull over. And the Aircastle call definitely confirms it. We are deep in a seller's market for good planes, likely for a few years.
Right. So my pitch to our imaginary investment committee really leans into how long this supply squeeze might last. The fact that getting new efficient narrowbodies, your 737 MAXs, your A320neos, is so tough seems structural, not temporary. And that should keep supporting lessors with decent fleets, even lessors who maybe aren't as highly rated as Aircastle, who don't have that investment grade status yet.
Ah, okay. So play the ratings gap, exploit the fact Aircastle just made that jump. What's the specific trade?
The trade. Go long a competing lessor, one that focuses on narrow bodies but is still stuck in high yield territory, below investment grade. The bet is aggressive, sure, but you're betting they can ride this capacity crunch, improve their metrics, and eventually get their own ratings upgrade, following Aircastle's path. Because moving from junk to investment grade, that unlocks huge value, not just from the assets performing well, but because their borrowing costs would plummet. Big potential return there.
Okay, bold. So if that's the long play, what's the hedge? What protects you if that thesis goes wrong?
The hedge. You short a legacy U.S. airline, specifically one flying an older, less fuel-efficient fleet. Why? Because these guys often lack the financial flexibility, they can't easily handle fuel price spikes, and crucially, they're getting squeezed hard by rising lease rates, the kind of rates lessors like Aircastle are demanding now. These older carriers may be paying through the nose for short-term leases just to keep flying their schedule. They'll be the first casualties as operating costs keep climbing in this tight market.
Makes sense. Okay, let's wrap this deep dive up. Aircastle. Exceptional net income growth, yes. Secured those crucial dual investment grade ratings, huge de-risking move. And they successfully shifted the portfolio towards newer, more valuable planes, all while keeping utilization basically perfect at 100%. Pretty impressive execution.
Yeah, the final thought really is that combination. They've got a stronger investment grade balance sheet now, and they're operating in a seller's market that looks set to continue, thanks to the OEM issues and maybe most importantly, those ongoing GTF engine problems. It really positions them well for steady growth and solid margins into fiscal 2026. They look well set up.
All right, one final provocative thought then, just for you to chew on. What if the Pratt Whitney GTF maintenance backlog gets sorted out way faster than anyone expects? How quickly do you think the pricing power, the high lease rates for those midlife narrow bodies, the planes that are super valuable right now because of the shortage, how quickly would that advantage just evaporate? Something to think about as you keep tracking this sector. Thanks for joining us on the Deep Dive.